Hey there, future homeowners. Welcome to my channel. I'm Tim Hill with Dominion Lending Primex Mortgages, and I'm here to save you money on your next mortgage. One of the biggest questions I get is, how much house can I actually afford here? Whether you're dreaming of a condo in Yaletown or a family home in Surrey, the answer depends on a few key factors. And the Lower Mainland's pricey market makes it extra tricky. In this video, I'll break it all down so you can figure out your budget with confidence. Stick around and let's get started. First, let's talk about why affordability matters in the Lower Mainland. This region's housing market is no joke. Average prices in early 2025 are around $1.2 million. In Vancouver, $900,000 in Burnaby, and maybe $700,000 if you're looking at townhouses in Surrey. That's a big range. Knowing what you can afford keeps you from falling in love with a home you can't buy, or stretching yourself too thin. As a mortgage broker, I've seen how a clear budget saves time, stress, and heartbreak. So, how do we figure this out? It comes down to four main pieces. Factor 1. Your income. This is the foundation. Your income is the bedrock upon which your financial stability is built. It determines not just your day-to-day living, but also your long-term financial health. Lenders look at your gross monthly income before taxes to decide how much they'll lend you. This figure is crucial because it gives lenders an idea of your ability to repay the loan. They want to ensure that you have enough income to cover your mortgage payments, along with other financial obligations. A good rule of thumb is the 30% rule. Your housing costs, mortgage, taxes, insurance shouldn't exceed 30% of your income. This rule helps you maintain a balanced budget, ensuring that you have enough left over for other essential expenses like food, transportation, and savings. Let's say you and your partner make $100,000 a year combined. This combined income is what lenders will consider when determining your borrowing capacity. That's about $8,300 a month. This monthly income is what you'll use to budget for your housing costs, utilities, groceries, and other living expenses. At 30%, you could spend $2,500 on housing. This includes your mortgage payment, property taxes, and home insurance. Sticking to this rule helps you avoid becoming house poor, where too much of your income goes towards housing costs. But here's the catch. Canada's stress test in 2025 means you qualify at a higher rate, like 6%, not the 4.5% you might actually pay. This stress test is designed to ensure you can handle higher interest rates in the future, but it also means you might qualify for a smaller mortgage than you anticipated. That shrinks your borrowing power. The stress test reduces the amount you can borrow, making it more challenging to afford a home in expensive markets. For that $100,000 income, you might max out at a $500,000 mortgage, less than you'd hope in Vancouver. This means you'll need to either save a larger down payment, look for a less expensive home, or consider other financing options to make your home ownership dreams a reality. Factor 2. Your debt. Debt is a critical aspect of your financial health and can significantly impact your ability to secure a mortgage. Lenders don't just care about what you earn. They look at what you owe. They scrutinize your existing financial obligations to assess your risk level. They do with what are called debt servicing ratios. They measure your monthly debt payments against your monthly income. They use two calculations: GDS, gross debt service, normally up to 39% of income, and TDS, total debt service, typically up to 44%. These ratios help lenders determine how much of your income is already committed to debt payments. So, with that $8,300 monthly income, add in a $500 car payment and $200 credit card minimums. These debts reduce the amount of income available for your mortgage. That's $700,000 in debt. This amount is subtracted from your income when calculating your mortgage eligibility. Your total housing and debt can't exceed $3,323. 40% of income. This limit ensures you have enough income left for other expenses. High debt cuts your mortgage size fast. The more debt you have, the less you can borrow for a home. In the Lower Mainland, where homes are pricey, paying down debt can unlock a bigger budget, like going from a $400,000 condo in Richmond to a $600,000 one in Burnaby. Reducing your debt can significantly increase your purchasing power, allowing you to afford a better home. Factor 3. Your down payment. This is your skin in the game. In Canada, you need at least 5% down, $35,000 on a $700,000 Surrey townhouse. But for anything over $1,500,000, like a Vancouver detached home, it jumps to 20%. So a $1.2 million house needs $140,000 down. More cash means a smaller mortgage and lower payments. Struggling to save? You can pull $35,000 from your RRSP as a first-time buyer, or maybe get a family gift, which is quite common in the Lower Mainland. And we even have reverse mortgage strategies to help with that. I've helped clients boost their down payment to afford places like Coquitlam instead of Langley. Factor 4. Interest rates and extra costs. Rates in 2025 are so far hovering around 4.5% for a 5-year fixed. Pretty decent. On a $500,000 mortgage, that's about $2,500 a month. But bump it to the stress test rate of 6% and it's $3,000. Same loan, higher bar. Then add Lower Mainland extras, property taxes, say $3,000 a year in Surrey, $5,000 in Vancouver, insurance, and strata fees if you're in a condo, like $600 a month in downtown Vancouver. These pile up fast, so your $2,500 housing budget might only cover a $400,000 mortgage once extras hit. Rates and costs shape everything. So, let's put it together with an example. Imagine you and your partner are navigating the complex world of home buying. You're a couple earning $120,000 a year, $10,000 a month. This is your combined income, which gives you a solid foundation to start planning. You got $1,000 in debt payments. This could be from student loans, car payments, or credit card debt. Managing this debt is crucial as it impacts your borrowing capacity, and $50,000 saved for a down payment. This savings shows your commitment and readiness to invest in a property. At 4.5%, a $600,000 mortgage costs $3,000 a month. This interest rate is a key factor in determining your monthly payments. But the stress test at 6% cuts you to about $500,000. The stress test ensures you can handle potential rate increases, safeguarding your financial stability. Add your $50,000 down payment, which reduces the amount you need to borrow and lowers your monthly payments. And you're looking at a $550,000 home, maybe a Burnaby condo or a Surrey townhouse. These areas offer diverse options for new homeowners. Want more? Pay off debt or save bigger, like $100,000 down for a $700,000 place. Every situation's different, and your financial goals will shape your journey. And that's where I come in as your mortgage broker, crunching these numbers for you. I help you navigate these complexities, ensuring you make informed decisions for your future. There you have it. How to figure out what you can afford in Vancouver and the Lower Mainland. It's all about income, debt, down payment, and rates, mixed with a dose of local reality. If you're ready to nail down your budget, or just curious what's possible, I'd love to help. Drop me a comment below, or email me for a free consultation. Hit that like button if this helped, and subscribe for more mortgage tips. Until next time, happy house hunting.